Hi, I'm Veronica. In the next few minutes, I'm going to show you how to execute an options trade called the long put option, a trade that simply gives you the right to sell a stock to someone else at a specific price at some point in the future. Brokers want you to think this is a complicated trade, so you'll pay them to do it for you. But I'm here to tell you that by doing your homework, you can understand the long put option strategy. Investors use the put option strategy when they're predicting a certain stock will go down in price. If you buy a put option with a strike price equal to or above the current market price, and the price of the stock goes down as you predicted, you can sell the underlying stock to a buyer at a price higher than the market price. Kind of like selling a Toyota for the price of a Mercedes. And even better, you don't actually have to own the stock to do it. You can simply sell the put before it expires and pocket the difference between your purchase price and the sale price. Here's how it works. I'll be using Zecco Trading as my options trading platform. When you buy a single put option, you get the right to sell 100 shares of stock at a certain price at some time in the future. That price is called the strike price. Of course, nobody is going to give you this right for free, so the amount you pay for the put is called the option premium. The premium is the most you'll ever lose on this trade, even if the underlying stock goes up, plus any commissions you paid to purchase the option. So you know right off the bat what you're risking. Now, if the underlying stock goes down, your gain is leverage because each option contract gives you the right to sell 100 shares at a price over the market price if the strike is above the current market price. You with me? Let's look at a specific example. Say you think a stock which is trading at $10 a share is about to plummet. Sure, you can short 100 shares at $10 a share for a total investment of $1,000. But let's say you don't have $1,000 or you don't want to invest $1,000 off the bat. You can get in on the action by purchasing an at-the-money put option, meaning you're buying an option with a strike at the current price of $10. Let's say the price of that contract is $1. Since each option controls 100 shares, it'll cost you $100 plus commissions to purchase that option. You now own the right to sell 100 shares of that stock at $10 a share at any point in time before the option expires. Now let's say the price of that stock goes down to $8. You can sell that option and make $200, less your original $100 investment. So you're up $100 net, and since it only cost you $100 in the beginning, you're up 100%. Of course, you'll need to factor in trading commissions into these examples as they will reduce your returns. And make no mistake about it, this is a short-term strategy. You must be willing to take on short-term risk with the possibility of a 100% loss in return for the possibility of a large percentage gain. If the price of the stock goes up or doesn't move by the expiration date, then you lose your initial investment, in this case $100 plus commissions paid. Remember, if your option is in the money, you'll probably want to sell it before it expires. So why can this be a good trade? 3 reasons. First, it's easy to trade. You only have to trade a single put option to execute it. Second, with a put option, you have limited downside exposure. You can never lose more than what you paid to purchase the option, including commissions. And third, it's a leverage trade, meaning if you're right about your predictions in the movement of the stock in the short term, your gain can be substantial, relative to the amount of money you risk on the trade. Get it? Good. See, you're a lot smarter than those brokers give you credit for. Want to learn more? Check out our educational resources available at the Zecco Options Learning Center. Thanks for joining me. See you next time.